Hello, my name's Clive Thompson. I live in Switzerland. The little boy beside me is my son, age 8. Today's video is a timeless video.
Daddy, what's timeless mean?
Timeless means you can watch this video tomorrow, next week, next month, next year. This video is going to be good even in 10 years' time, and it's about buying stocks and how to make a lot of money buying stocks. And each video, I will talk about a single concept, a single thing.
Daddy, what does concept mean?
Oh, well, it's a thing which you learn about. It's something which it explains how things are done and how things work. So today I'm going to be talking about two things that are important, and I'll come on to explain why they're important later. Now, I'm going to be talking today about price-earnings ratio, or PE ratio.
Okay.
And I'm going to be talking about the PEG ratio. And then you may know these things, so don't switch off, because you're later on going to learn something much more important about why these things are important, and also can make you a lot more money if you know how to apply them correctly. Do you have any questions?
No.
So let me explain what a price-earnings ratio is, or PE ratio. When you're looking at a stock, like an equity, to get the price-earnings ratio, you take the price and divide it by the earnings. Price divided by earnings, that gives you the price-earnings ratio, or PE ratio as it's commonly known. Now, in general, and this is not as simple as this, but I'll talk in a simple way to start with, a low PE ratio is good. Low price-earnings ratio means the stock is cheap, and a high price-earnings ratio means it's expensive. So if we look today at cheap and expensive stocks, you'll find stocks like Nvidia, which are on price-earnings ratios 50 or something like that, which is a high price-earnings ratio, and you'll find stocks like Volkswagen, which is on a price-earnings ratio, say 5 or 6 or 4. That's a low price-earnings ratio. So at first sight, it would seem easy, you just buy the low price-earnings ratio company, but that's not all there is to it, because you also want to be buying growth. And so I'm going to now explain what the PEG ratio is, or PEG, or PEG, price earnings growth ratio. So we just described what the price earnings ratio is. That's price divided by earnings, the earnings per share, of course. And now to get to the PEG ratio, we take the P ratio and divide it by the growth. So if you've got a company which has got a price earnings ratio of, let's say, 10, and it's got a growth rate of 10, i.e. the earnings per share are going to grow by 10% a year, you can take the P ratio of 10, divided by the growth rate of 10, and get to 1. That's the PEG ratio of 1. Now, again, I'm going to tell you straight out, a low PEG ratio is better than a high PEG ratio. So if, for example, a company was only going to grow at 5%, it's on a P of 10, and the growth rate is only 5% a year, then your PEG ratio is 2. So when we take a high growth stock like Nvidia, which is on a price earnings ratio, I'm just guessing, I don't know what the price earnings ratio of Nvidia is, but it's going to be high. Let's say it's 50. Are they growing the earnings at 50% a year? Probably not. Probably 25% a year. So that would be a PEG ratio of 2. Now, obviously, PEG ratios of 2 aren't that expensive. You'll find plenty of companies with PEG ratios of, much, much higher than that. Of course, there are some which cannot be calculated because the company is making a loss. But the point I'm trying to make is you want to make at the first sight, and we haven't got to the important bit yet, you want to be looking at companies with a relatively low PEG ratio, a relatively low price earnings ratio. So let's have a look at an example of why a low price earnings growth ratio, or PEG ratio, can be a good thing. And a low PEG ratio is only good if you do have that growth. Now, I'm going to just take you away from stocks for a minute to look at houses for a second, because it's perhaps easier to understand with the concept of a house than a stock. But stocks are, everything has a price. A house has a value and it has a price, which might be different. A stock has a price and it has a value, and those two might be different. But let's take a house where, in general, price and value are the same thing. So I'm going to give an example. There's a £1 million house, or a £1 million house, or $1 million house. And you can buy that house now, and let's say next year the house goes up by 10%. So the house has now gone from 1 million to 1.1 million. It's gone up by 100,000. You've made a profit of $100,000. Nice and easy. But let's suppose that you have the opportunity to buy a house in viager. Now, if you don't know what viager, it's a Swiss term or a French term, if you like, which means you basically buy the property, allowing the present occupier to remain in residence for the rest of his life.
What's a residence?
Residence when he lives in it. So the occupier lives in it for the rest of his life, but because he can live in it for the rest of his life, you can't live in it because it's his property, you pay a much lower price. So if you buy a property in viager, it might be worth, let's say, 1 million francs or $1 million, but you're only going to buy it maybe at half price at 500,000. Now, you buy that property at 500,000, but next year property prices go up by 10%. So don't forget this is a 1 million property which you bought at 500,000. So that 500,000 you paid is worth 100,000 more, which is 20% of 500,000, as opposed to the 10% of 1 million if you would have paid the full price. So here's the thing. By buying a property at less than full value, every increase in value gives you a leveraged effect. It gives you more. So for your smaller investment, you're getting just as much gain as somebody who paid a lot more. And so in fact you could, if you're only paying 500,000, buy 2 houses in viager and have 2 lots of 100,000 gain, which is 200,000 gain, as opposed to the guy who paid full price. Now, that's explaining it how it works in houses to make it simple, but now I want to explain it as regards stocks. Now, don't forget, stocks are businesses. So when you buy a share in a company, you're buying a slice of that business. It might be only 1,000th or 100th or 1,000,000th of a percent, but you're buying a slice of the business. If that business makes a profit, so will you. So let's take a business and you invest, let's say for simplicity, let's say $100 into the shares of the company. And the next year, that company increases its earnings per share, makes a profit of 10%. So it's got an extra 10%, which it decides to distribute as a dividend. So if you paid $100 for the company and you get a dividend of the $10 profit it made, you're making a profit of 10% or $10. But what about if that, because the stock market's having a bit of a fright, the stocks are down, and you could buy that stock not at $100, but at $50. But the business in this particular case is still the same. It still makes the same profit. It still makes $10 profit per share, and it still distributes a dividend of $10 per share. But because you paid $50, your share of that increase is that much greater. So now you're making a profit of $10 on the 50 you invested, which is 20%. So the concept I'm explaining here is when you buy something at a low price, and if there is an increase in anything, that could be increase in sales, increase in earnings, increase in dividends, or increase in something else, the less you paid, the bigger your share of that increase is. So that's one of the concepts of stock market investing. Of course, there are many other ways of investing, but I'm talking about a style of investing here. I call it, or people call it GARP, G-A-R-P, growth at a reasonable price. If you invest in stocks at a reasonable price, which have growth at a reasonable price, you want to buy growth, that growth when it comes is worth much more to you than if you bought a stock at a very high multiple and you overpaid for it. So, it's absolutely great buying wonderful companies which are growing their earnings per share very, very rapidly. But if you pay an extremely high multiple for it in terms of the price earnings ratio relative to that growth, then you're overpaying and you won't get such a big share of that earnings increase. So in general, what we see at the moment in the stock market, and this of course can change, is that stocks which are the darlings of Wall Street, they're on quite high multiples, and in general those multiples are much higher than the growth rate, meaning you have a PEG ratio, that's price earnings divided by growth, which is higher than 1, and in some cases much higher than 1. So you'll struggle to find low PEG ratio companies anywhere. You will find some which are on PEG ratios below 1, and you'll find some a few more below 2 and quite a lot below 3 and lots below 4 and 5. But you'll also find lots and lots with PEG ratios well above 5, and those are the expensive stocks. So I think my point here is, if you are wanting to adopt one particular style of investing, and should be one of many styles. I'm a multi-style person. I don't have just one style, but the style I'm describing today is value investing with growth, or GARP, growth at a reasonable price. In other words, you're looking for companies with a low PEG ratio. If that's one of your styles, you want to be looking at those low price earnings ratio companies. Low price earnings ratio with high growth. Hard to find, because usually when you have a low price earnings ratio, there's something wrong with the company. Maybe it's in a very risky country, or maybe there is some turmoil going on in the company, which means that growth is not very certain. Because you'll find it very hard to find a company with guaranteed high growth and a low price earnings ratio. They tend not to go together, but sometimes it can happen. I'll give you an example. For example, if the founder of a company has recently died, it may be that his heirs have to sell off the shares in the company in order to pay the death duties in some countries. So that would be a reason why the stock price might be low, despite the wonderful prospects for the company. So that's kind of the end of the video. Have you got any questions?
No.
You understood the whole lot?
Yes.
So there you are, an 8-year-old genius. He's going to be my financial advisor soon. But if you like this video, just give me a thumbs up, give it a like and subscribe, and I'll be making lots more videos about lots of different investment styles. I use all the investment styles of the greatest investors in the world, and they all work at times, and lots of them don't work some of the time. So you shouldn't be overly exposed to one style, but if you know what all the styles are, you can have a portfolio of equities with multiple investment styles, and no matter what the world throws at you, some of those styles will be doing well. And thank you everybody for listening and watching. Bye for now.